Hi everyone, and welcome to our second webinar in the series titled An Ongoing Concern. By way of introduction, my name is Laura Hinsley and I'm one of the audit partners here at Azets, and I'm thrilled to be joined by both Richard Tonks and Ben Sheldon, who will lead you through our webinar over the next hour. Richard is one of our restructuring and insolvency partners at Azets, and he'll be providing an overview of both the current economic environment as well as delving into the director's legal duties in relation to going concern. We'll also look to provide some useful insights into preparing forecast models, which I know will be really beneficial given the auditing changes that are on the horizon. We're also joined by Ben Sheldon, who's one of our senior managers, and he also sits on ICAW's Technical and Practicing Auditing Committee. Ben will be concentrating on the upcoming changes to ISA 570 and explain how the audit evidence bar is being continually heightened. We're going to have about an hour for this whole session, so we'll look to keep the presentation time to around 30 to 40 minutes, and we'll then have a question and answer session at the end. Please do feel free to submit questions throughout the presentation, and then I will field those to the appropriate person at the end of the presentation. We also have a poll today, which will pop up on the screen at the appropriate time, and each of you will probably have around 30 seconds to answer that, and we'll then reveal the results to the group as a whole. I'll now kindly pass you over to both Ben and Richard. Thanks.
Thank you, Laura, and can I just reiterate Laura's welcome to you each. Hopefully will be a useful session for you, and no doubt on today's webinar there'll be a number of different organisations represented, some corporate entities, others charities and not-for-profit entities, schools, and equally there'll be a number of different individuals and job roles on today's webinar, those who are statutory directors of organisations and those who are financial controllers. Hopefully throughout this webinar there'll be something for you, whether it be a focus on how the auditing standards are changing and the work that we do around going concern will be changing equally, or whether it's you represent a business which is struggling in the current climate and has very real going concern problems and questions, and perhaps Richard's slide in the second half of the presentation will be particularly helpful for yourselves. Well, as you know, the focus on going concern in the past year and 2 years has really been heightened by a number of high-profile corporate fails, and the next slide shows just a few of those. Thomas Cook, BHS and Carillion, and those high-profile business failures where both auditors and directors were culpable have resulted in a much heightened focus by the FRC, the Financial Reporting Council, and as a result of that, a new auditing standard, International Standard of Auditing 570, is being amended. It's being revised, and the unfortunate thing, or the fortunate thing, depending on your point of view, is that that standard applies both to the large listed businesses and the small SMEs and charities and trusts and every type of organisation that is audited within the UK. And as a result of that heightened focus and that heightened standard, there'll be a great deal more work for auditors to do for financial year ends ending 31st of December 2020 onwards. And so if you fall into that camp, if you fit into those categories, then shortly we'll come on to some of those auditing changes. Well, I'm just going to hand over to Richard shortly, who's going to give us a little bit of an overview of the current economic environment. We know that the COVID-19 pandemic has had a fundamental and significant impact across organisations from every sector. But Richard, what does that mean for corporate failures and insolvencies so far this year?
So good afternoon, everyone. Thanks, Ben. Apologies for showing a government prepared slide so early in our presentation. I can confirm that there won't be any more, so it won't get any more technical than this from a government slide perspective. And you'll also be pleased, I think most of you, to see that unlike many of the slides we've seen recently, the trend is a downward trend. it represents the corporate failures for the year to date, or up until August, which is the last available information, and it obviously demonstrates that there's been quite a sharp fall in the number of corporate insolvencies compared to the same time last year and previous years. That can include lots of reasons, including, of course, the fact that courts were closed for a period of time earlier during the pandemic and weren't hearing things like winding up petitions or otherwise made small legal changes to be able to try and protect businesses from failing that would otherwise not be in trouble had it not been for COVID. You would have to argue that the government response, good, bad or indifferent, has clearly reduced the amount of corporate failures that you would have otherwise expected for the same period. Whether that will continue indefinitely, we're going to ask you to opine on in a second. The one thing that might not be obvious from that slide is that administrations, which you not always but generally would associate with larger entities that have gone through an insolvency process, those numbers for the period May to August this year compared to last year were approximately 8%, so only 8% down on the previous year. So there has still been many casualties, and we're now going to ask you to opine on the as part of our poll with the question that, providing some sense of normality resumes in spring 2021, do you expect there to be more or less corporate failures? So hopefully on your screen is now showing the poll. You get to answer the question, do you think there'll be more or less? And I'll just give you a few seconds to consider that before we discuss the results. So hopefully that's given you all the opportunity to select one of those answers. Hopefully the immediate results will appear shortly. And so there we go. Quite obviously a sizable difference there of those that think there will be more corporate insolvencies if we get back to some normality. I'd have to say that's consistent with my own view. The anticipation at the moment, again, whether you feel that the government support that has been provided to date has been good, bad or indifferent, it has clearly deferred a number of problems or postponed potentially a number of issues. Who knows what support will look like in the future, but the anticipation from speaking to clients of our own who are putting steps in place to try and plan for all kinds of eventualities is that there's likely to be more. And I can only sort of suggest that as part of that, and obviously that there's a overwhelming majority as part of this poll, is that now is the time to start considering some of your strategies, policies, and how you might deal with any corporate failures, or indeed any failures within your supply chain or within your customer chain, and try and prepare for those eventualities. Now hand back to Ben to talk to you more about the specifics around going concern. Over to you, Ben.
Thank you, Richard. As you can see there on the slide, we've got a dictionary definition of going concern. But what do we mean when we say going concern? Well, simplistically, we mean the assumption, the underlying assumption, that a business or an organisation, a charity, a school, whatever the organisation is, will be able to continue to trade and operate for the foreseeable future, or more specifically 12 months from the date of the audit report. A common misconception is that it's 12 months from the year end. It's actually from the date of the signed accounts themselves. And obviously for stakeholders in accounts, for shareholders and other key stakeholders, whether a business can continue is one of the fundamental things that they need a set of accounts to tell them. And so the area of going concern is a particularly important one. The current audit report wording that auditors issue, assuming that there aren't any concerns around going concern, is phrased in a negative sense, i.e. there's nothing to report from our audit procedures that would suggest that the going concern basis is inappropriate. ISA 570 changes that conclusion to a more positive, a stronger statement, if you will. Instead, auditors will have to conclude that there is not a material uncertainty in relation to going concern, and conclude that the basis of going concern is indeed appropriate. If I was to bring an example, or a real world example to that, I'd liken it to searching through a haystack for a needle. And under the previous ISA, we might design some procedures. We're going to sift through the hay to find that needle. And assuming that we haven't found it, we would conclude that there's nothing to report from our procedures, from our sifting, that would suggest that there is a needle in that haystack. The new ISA requires the auditor to take a scanner to the haystack. It requires us to take a metal detector and definitively say there is not a needle in this haystack, or there is not a problem with going concern. So as you can see, it's a subtle wording change, but a different conclusion, a more useful conclusion actually for users of financial statements. In the words of the government press conferences, if we could have the next slide, please. Why does your auditor conclusion on going concern matter? Well, it affects your credit rating directly. The credit rating agencies monitor accounts being filed at Companies House, and if there's a material uncertainty around going concern included in an audit report, that will be flagged. And so if your organisation is looking to raise finance, whether it be to get through a tricky period, or whether it be to raise money to invest in new plant and machinery, or a new subsidiary, whatever it may be, your credit rating is affected on the basis of the audit report. Your ability to trade with suppliers and customers is affected. If there's a material uncertainty that's disclosed, you may find that credit terms are cut with suppliers. You may find that customers are less inclined to come to your organisation. You may find insurance premiums rise. And particularly at the moment, throughout the pandemic, the opinion of the auditor on going concern would indicate how successfully or not a business is coping through the pandemic. So how does this impact upon changes to our audit work? Well, the new ISA requires the auditor to actively assess for management bias. So we need to think, are there any factors here that those in management at businesses may be present that influences their decisions around going concern? Now that, of course, is quite an invasive or intrusive thing to ask or to say, but that's what the new auditing standard requires us as independent auditors to do. We're required to perform a stand back test, which means really that having considered all the evidence, we stand back and reflect, and we look at other businesses in your industry, and we say, well, that business is struggling and is suffering. Is that an indicator that maybe the industry at large is facing difficulties, and how does that impact on your organisation? Again, it may feel uncomfortable to be asked these types of things, but actually the auditor challenge, if it's robust and if there's an open dialogue between auditor and client, it can actually be really beneficial to you as directors and as key senior management to understand your own business, to make sure that you are prepared for the next 12 months and beyond. As auditors, we'll need, and already we need, to understand and challenge those forecasts and budgets that you've prepared, including any key assumptions that are included within them. We need to analyse post-year-end performance. Has margin been hit in the post-year-end period? What would that indicate? Does that have implications on the long-term viability of a business? And for some organisations who are represented on today's webinar, no doubt some of you will rely on letters of support from your parent companies or from shareholders. You'll find that in the year ahead there'll be much more challenge around those. Are they appropriate? Is the level of support sufficient? is the level of support in place for long enough? Remember, at least 12 months from the signing of the accounts is the generally accepted period. And so I guess the message that we need to convey here is that be ready for even greater challenge. Well, the COVID pandemic has meant that we have, as auditors, needed to challenge going concern work a lot more, but be ready for those December year ends onwards. There's a new ISA to be aware of. So how can you make sure that your finance department is audit ready? Well, the first thing to do is prepare a going concern paper. At least have thought about why your organisation is indeed a going concern, and that is a helpful thing to do as directors. You know, what is it that means you're happy as a director that your business will be able to trade for the foreseeable future, and articulate that to the auditors. Prepare budgets and cash flow forecasts for at least 12 months from that signing date. Now, this might not be something that you're particularly used to doing, and indeed we can advise and help on those. We cannot, as auditors, prepare them for you, but we can give indications as to what we'd like to see to make sure that we are comfortable, that there is sufficient cash headroom, that you have the facilities in place to be able to trade for the foreseeable future. Ensure that those budgets and forecasts are sensitised and contain any one-off items, and hold regular catch-ups with your auditors throughout the year. If there is a going concern problem, raise it with the auditor early in the year, early in the process, even before the year-end audit planning is started, so that dialogue can be started and can continue throughout a financial period. These are all things to make that audit process as pain-free as possible. Well, at this point now, I'm going to hand over to Richard, who's going to really bring a different emphasis now, away from the audit perspective and more onto some of those duties and responsibilities of directors. Thanks, Richard.
Thanks, Ben. If a pain-free audit doesn't get you all excited on a reasonably dismal November Wednesday, then what I'm about to talk about will definitely get you excited. So a lot of what I'm going to talk about hopefully is information that you're already aware of, and the roles of a director. I'm conscious there's many directors on the call, so some of it is just going to be a bit of homework, and then I will talk about what I might look for as a restructuring advisor when looking at going concern, what kind of information I would be interested in looking at, and also how that dovetails in then with, I've called it the fiduciary flip, with any instances where there might be an issue, and what the directors might want to look at or consider as a consequence of that. So if we could move on to the first one, please. So hopefully all of the information on this slide is familiar. It's well versed, well known, and so I'm not going to go through it in great detail. Directors are required to act within their powers. The powers conferred on them by the company, which is generally the shareholders, and they should only exercise those powers that have been passed to them. Generally, you would find those powers, or expect to see those powers, in the company's articles, or perhaps supported by a service agreement that may or may not form part of a contract of employment as well. Sometimes they are all combined, sometimes they are in individual documents, but it would be important to be able to demonstrate that those documents and processes all exist. To promote the success of the company and to always act in good faith, I think that one will be would be pretty standard, pretty well known. Things like avoid conflicts of interest maybe is not one that is at the forefront of people's minds. And of course, in most examples, if you identify a conflict of interest, that doesn't necessarily mean that you have to cease to act as a director. But certainly the perception of the conflict, or indeed the actual conflict, should be raised with fellow board members or the company itself, and simply keeping a record of any of the things that are on this slide, or any material matters that could affect a director's or individual responsibility to act diligently. Keep a record of them, because of course it's much easier to demonstrate if there is a subsequent problem somewhere down the line. It's much easier to demonstrate the thought process or the matters that were considered in light of that written evidence. Moving on. So these are more general duties, a duty to manage the company. Obviously that management can be delegated into individual tasks such as sales or income-led roles or operational activities, or even day-to-day managing director responsibilities. Again, the powers would normally be defined in an individual's service contract or indeed the articles themselves. The need, of course, to complete periodic returns and comply with legislation, which is something that obviously is close to Ben's heart, but also the need to comply with other related legislation. Some things pretty straightforward in terms of, well, straightforward. I'm saying the Bribery Act is straightforward, but the need to comply with it, I think, is pretty well known for a director. The same for health and safety. But of course, there may also be other statutes or governance that's required specific to the industry that you're in, whether, Charities Act, for example, for trustees, and other sort of common areas. So hopefully that is pretty common ground for everybody, and just a bit of sort of a refresher in that regard. Next slide, please. So going concern, so linking into what Ben talked about, what would I look for as a restructuring professional to try and satisfy me, either on behalf of a company, or indeed one of my audit colleagues, or indeed a bank or another stakeholder, to satisfy myself that an entity was a going concern. I would obviously look at management information, the recent accounts, all of the publicly available information that exists, but hopefully some more detailed information that could be provided from the entity. And in terms of looking forward, obviously the need to prepare forecasts and budgets has been covered by Ben, but I would say that simply the existence of those documents, from my perspective, is a key component, that it's something that's being thought about by the management board, and hopefully regularly reviewed in the same way that you would review the management information pack from, say, a management accounts perspective. The need to review both historic transactional activity, the current position, and the anticipated future position, for me all go together, and hopefully for many of you the same. The ability to produce consistent information, and by consistent I mean both in terms of presentation, but also something that is in line with information that has been prepared historically from a management accounts perspective. It's very difficult, I think, for directors, let alone then somebody coming in from the outside, to understand and decipher the comparables between management information and forecast information if they look and feel and are set up in a totally different manner. So hopefully a process that you can put in place to have common themes, common ways of reporting, will be much easier then to identify an entity that is obviously that is a going concern, or perceived to be a going concern, or indeed identify some shortcomings in areas that need to be addressed. Integrated models is a really interesting one, and again quite important, I would say, the link between profit and loss, cash flow movement, and balance sheet. It's obviously reasonably straightforward if you just wanted to produce a profit and loss forecast to do something in Excel or something with one of the existing accounting providers, but the ability to link that to balance sheet and cash flow movements as well will really give directors and their advisors a really rounded view of the prospects going forward. Estimate of closure costs. Clearly, if a company has given some thought to, well, what might the costs of closure actually be, and if they are £250,000 and we have £2 million of reserves, then it's reasonably easy to get comfortable to the point that, well, if there is a worst case scenario, God forbid, we should still be okay, and that will be a really helpful test for me, and I'm sure the guys that perform the audits to consider those. As I think Ben referred to as well, there would be some sort of external factors, some sector considerations and market factors. And for the avoidance of doubt, we're saying these things as if they all sound incredibly easy. We appreciate that they're not, and in the current climate, both economically and with everything else that's going on, we do appreciate that it's incredibly difficult to consider whether you're going to go on holiday next year, let alone forecast what your business is going to look like in 12 to 18 months time. So the onus really is on directors to just do the best they can with the information that is available. Clearly, if you do have forecast models that are integrated or can be flexed and relatively easily adjusted for a change in government support mechanism, or a fluctuation or perceived fluctuation in sector or turnover or whatever it might be, then that's going to hold you, that planning is going to hold you in really good stead to try and fight any challenges, but also, of course, to try and satisfy your auditors that you don't have any going concern issues. In the middle of the slide there, I've referred to what I've called the fiduciary flip, and from an insolvency or from a restructuring perspective, if an insolvency threat exists, one things that directors ought to know, and hopefully do know in the main, is that there is then a shift of duty from one that currently exists to the company, and by definition the shareholders, to the creditors. Now, in most cases, you would envisage that the duties of a director to pay creditors and therefore achieve value for shareholders are likely to be aligned. But if there is an insolvency threat, then the directors do need to sort of take advice and consider that are the actions they are undertaking or proposing to undertake likely to be looked at differently in the event of failure. And at the far side of on the right hand side of that slide there's just some potential issues which I don't propose to go through in any detail. Hopefully people have heard of some of those things, but suffice to say, the thing that I want you to take away from today is that a transaction that is perfectly legitimate today in a solvent entity is just looked at differently if there is then a subsequent insolvency. And so the ability for a director or a group of directors to recognise the threat, assess it, deal with it, document it. If they then continue, well, of course, then they've got a good record of what they do. But if they can continue blindly or not really recognising the position, if there is a potential issue at some point in the near future, anytime, say up to 2-3 years' time, that's going to be looked at. It's going to be called into question. You're going to be asked to opine on why those decisions were taken and potentially why you didn't take alternative decisions. Moving on, please. So just in case people were not sure what the statutory definitions of insolvency were, I've listed them, or the most common ones, down the left-hand side. Just to pick out a couple of things on cash flow. Unable to pay debts as and when they fall due. I think most people will be familiar with that expression. You can, of course, restate or revisit the position of being unable to pay debts when they fall due in light of an agreement with a creditor to defer a debt. So, for example, with the HMRC deferment policies that are currently in place in response to COVID, you can reassess that, well, will I be able to pay my VAT at the end of March? Obviously, it could have been due several months ago, but you now restate it, retest it, and providing that you are able to pay at the end of March, then you are not unable to pay your debts as they fall due. And that will be the same whether it's HMRC or a trade supplier, as long as you have an agreement. If you are exceeding current credit terms, if you have an agreement to do so, then you can redo the test. And finally, on a balance sheet perspective, it's important to consider possible contingent liabilities when looking at the balance sheet. So obviously the balance sheet test is that your assets should exceed your liabilities, because if they don't, you are insolvent on a balance sheet basis. You should also consider the potential contingent liabilities of anything that's going on in your business when assessing that from an insolvency perspective, and I'd also say from a going concern perspective. On the right-hand side, there are some common insolvency procedures and phrases which hopefully you understand or are aware of in sort of practice and theory. Hopefully it doesn't happen to you too often, either whether it's in your supply chain or directly. There are a couple of relatively new procedures on there. One's called the restructuring plan and one's called moratorium. Again, partly in response to COVID-19, the government has introduced some new insolvency measures. If you identify somewhere in your supply chain clients or customers that are subject to restructuring plans or moratorium plans, those are insolvency procedures. So notwithstanding they are definitely designed to be part of rescuing a business rather than perhaps a liquidation, which generally sees the end of a business, you should still be sort of mindful of these are insolvency processes, and so what do they mean for your business.
I'm conscious we're getting close to our full hour, but I wanted to thank everybody for attending the session today. And there will be a slide hopefully popping up now, which is going to showcase the webinars that we've got coming on over the next month. So tomorrow we've got one around the UK and Ireland trade corridor post-Brexit. We've also got accelerating the world's transition to sustainable energy. And then another couple happening, one around remote working and how that has, I guess, we've seen an increase in fraud and cyber attacks. And finally, making sure that we are ready for 2021 post-Brexit in terms of customs duty and VAT. So please all register your interest on those, and I look forward to seeing you all on a future webinar. But thanks, Richard, and thanks, Dan, for today.
Thank you.